Hello everyone. Now we'll talk about the bank reconciliation, which is some form that we develop or put together in order to find the difference between what the balance we have on the bank statement and the balance we have in our records. So again, a bank reconciliation is an analysis of the items and amounts creating the difference between the cash balance reported on the bank statement, which we typically receive from the bank, and the balance of the cash account in the ledger, which is in our own records. The adjusted cash balance determined in the bank reconciliation is reported on the balance sheet. A bank reconciliation is usually divided into two sections, which we are going to call the bank section, and the other one is the company section. The bank section begins with the cash balance according to the bank statement and ends with an adjusted balance. The company section begins with the cash balance according to the company records or the ledger and ends with the same adjusted balance that we reached after we adjusted the bank section. So let's see how this would look like. So the adjusted balance from bank and company section must be equal, and this is the thing that we have to keep in mind. So you see here again one more time, we see the cash balance according to the bank. That's the one we start with. We make some adjustments, and then we reach an adjusted balance. On the other side, we also have the cash balance according to the company records, and this is the value. We make some adjustments, we add and deduct some other stuff, and then we reach an adjusted balance. These two adjusted balances should match. They should be equal. If they're not equal, then the bank reconciliation did not work out. So what are the things that we add to the cash balance according to the bank statement? We have to add things that we know, but the bank does not know about. Things like deposits not recorded by bank. So we call it deposit in transit. So for example, these are deposits that we know about, but the bank does not know about yet. Like let's say we have a customer who paid us a check, and we got the check, we recorded it in our records, but we didn't take it to the bank to cash it yet, or to deposit it yet. So in this case, that's a deposit in transit. This is something we know and that we updated our cash balance with in our records, but the bank does not know about it, and that's why the bank statement does not include it. So what are the things that we should deduct? It's the same thing. Outstanding checks not paid by the bank. So things we know but the bank does not know about. But it's things that we paid and the bank did not know about. So let's say we issued a check for a vendor, and we recorded this as a payment in our records, but the vendor did not cash the check yet. So in this case, we know about it, we recorded it in our books, but the bank does not know about it. Eventually they would know about it, but at the time we received the bank statement was not up to date. So we have to deduct the outstanding check balances that were not paid by the bank. How about our records? Our records need to be updated by things that the bank knows and we didn't know about. So things that need to be added are credit memos that have not been recorded. Like, let's say that the bank collected some notes on our behalf or collected interest on our behalf, and we did not know about it until we received the bank statement. The other side of the coin is the debit memos, which show things like non-sufficient fund checks, checks that bounce back to us, or service charges that the bank charges us with. So these are the things that we're going to deduct from our cash balance to get the adjusted balance. So I'm not going to go over all these stuffs, but I'll leave them for you to read. But we're going to apply them into an example so we can see how this can work. But the thing is, we start with the bank section of reconciliation, we follow these steps, and then we go through the company section of reconciliation. And then the last step, we verify that the adjusted balances determined in step 4 and 8 are equal. And that way, we know the correct cash balance. So let's see this example for power networking. We have the cash balance according to the bank statement, which is this value. We add deposit in transit, which is the amount of checks we collected but were not deposited in the bank yet. And then these are outstanding checks. So remember, deposit and transits are added, outstanding checks are deducted, and we write the check numbers with their values, and then we get the totals, and the total is $15.44.99. We subtract that from the balance to get the adjusted balance. That's by adjusting the bank statement balance. Let's look at the cash balance according to our records to the Power Networking Company. It was $25.49.99. We add a note and interest collected by the bank on our behalf, which is $408. Then we subtract things like check return because of insufficient funds, bank service charge of $18. There was an error for $9. So we subtracted these values and we reached $26.30.99. So you can see here the two values now are matching and are the correct value. So that would tell us that bank reconciliation was successful. So under the bank reconciliation, the company records do not need to be updated for any item in the bank section of the reconciliation. This section begins with the cash balance according to the bank statement. The company records must be updated for any item in the company section of the bank reconciliation. The company's records are updated using journal entries. So we update our records, but we cannot update the bank's records. So the journal entry for Power Networking based on the bank reconciliation would be as follows. We're going to debit cash by 408, credit notes receivable for 400, and we credit interest revenue of $8. So the cash is the amount of cash increased, and the notes receivable and interest revenue, this is the amount that the bank collected on our behalf. We did not know about it until we heard from the bank. For the payments, or for the things that were deducted, we have accounts receivable. This is the non-sufficient fund, so we increase the accounts receivable for that client again. We make it a debit for $300. We record the miscellaneous expense for the bank service charges of $18. And then we have accounts payable for Taylor Company. That's the error for $9, where we debit the accounts payable for this value. So the total of these values is credited to cash. So the cash is $327, which shows a reduction in the value of cash. Now let's talk about special purpose cash funds. A company often has to pay small amounts for such items as postage, office supplies, or minor repairs. So a special cash fund, we normally call it the petty cash fund, is used for these type of payments. A petty cash fund is established by estimating the amount of payments needed from the fund during a period such as a week or a month. So these are like very small payments that the company would have to make. We don't want to go through the vouching system, so an easier way is to have a petty cash fund that we replenish every period. So the petty cash fund is normally replenished at periodic intervals. It could be every month or every quarter when it's depleted or when it's reached a minimum amount. So assume that a petty cash fund of $500 is established on August 1st. The entry to journalize the transaction would be as follows. Now we are establishing the fund. We're establishing the petty cash fund. We debit petty cash and we credit cash for the $500. So we're moving it from one cash account to another cash account. The only time petty cash is debited is when the fund is initially established. And the only time petty cash would be credited is when the fund is being decreased or eliminated if we don't want to use it anymore. How about like every year or every quarter or every month if we want to replenish it? We don't use the petty cash account any longer. We use the cash account itself. So at the end of August, there is $30 of petty cash on hand and petty cash receipts for the following items. We got office supplies for $380. We have postage of $22. We have store supplies of $35, and other miscellaneous administrative expenses for $30, for a total of $467. So if the amount to replenish the petty cash fund does not equal the total of the petty cash receipts, the difference is recorded as cash short and over, the same way we've treated it before. And in this case, we have a shortage of $3. So since the total of the petty cash receipts is $467, cash short and over is debited for $3, as shown in the following journal entry. So we debit office supplies, we debit the store supplies, we debit miscellaneous administrative expenses with their values, and then we credit the cash for $470 to bring it back to $500, because remember, we were only left with $30. We used the cash account on the credit. We didn't use the petty cash. And then because of the $3 difference, we recorded that as cash shorted over. And it's recorded on the debit because it's a shortage. So companies often use cash funds for special needs such as payroll or travel expenses. Such funds are sometimes called the special purpose funds. So that's another form of special purpose cash funds. We don't want to keep using like the same cash balance for payroll purposes or for travel purposes. We usually keep a separate account for these like repetitive kind of payments. Now let's talk about financial statements reporting of cash. So cash is normally listed in the first asset as the first asset in the current assets section of the balance sheet. Most people, they like to know how much cash is in the company. So the first line under current assets is normally cash. Most companies present only a single cash amount on the balance sheet by combining all their bank and cash funds or cash fund accounts. A company may temporarily have excess cash. It's not a good idea to have a lot of cash sitting with no use. It's not a very good use of the resources you have. Of course, on the individual level, this is different, but for businesses, it's better to invest this cash and make the company grow. So in such cases, the company normally invests in highly liquid investments in order to earn interest, and these investments are called cash equivalents. So here we have a presentation of the cash for eBay, where you see under current assets on their balance sheet, they have cash and cash equivalents of $975 million. And then on the notes, you see this kind of footnote that says cash and cash equivalent are short-term, highly liquid investments with original maturities of 3 months or less when purchased, which may include bank deposits, U.S. Treasury securities, time deposits, and certificates of deposits, well known as CDs. So here's an example for how it's presented on the balance sheet. So banks may require that companies maintain minimum cash balances in their bank accounts, such a balance, we call it compensating balance. So I know this might sound odd, but I just want you to be familiar with the term compensating balance. Like we'll lend you $1 million, but you have to maintain $100,000 in the checking account. So this way, this is what they call it, compensating balance. So this way, the bank look at it as if they're only lending you $900,000, not the $1 million. So this is often required by bank as part of the loan agreement or line of credit. A line of credit is a pre-approved amount the bank is willing to lend to a customer upon request. The idea of line of credit is very similar to the credit limit on a credit card. So let's say you have a credit card with a limit of $5,000. Like on the personal level, that's the line of credit you have through that bank. Now let's do some analysis for decision making, and we're going to go through a ratio called days cash on hand. The days cash on hand measures how long a company could survive if its sources of revenue were to decline significantly. So let's say if they don't have revenue, how long they can maintain their operating expenses using the cash and the other short-term investments. So a higher number of days implies a higher liquidity, and it's viewed favorable by creditors. A number of days cash on hand that is too high may indicate that the company has not invested cash back into the business or returned profits back to the owners. So how is the ratio calculated? It's the cash and short-term investments divided by daily cash operating expenses. We get the operating expenses divided by 365 days. So the cash and short-term investments are taken from the year-end balance sheet and represent the most liquid assets. The daily cash operating expenses are computed from income statement information, and this is calculated as follows. We get the operating expenses minus the depreciation. We exclude the depreciation expense, and we divide it by 365 days. Why we exclude the depreciation expense? Because depreciation expense is not a real cash expense. It's allocation of the cost of an asset over its useful life. In the operating expense, we want to only focus on the cash payments because we want to see like how long we can survive with the cash balance we have. So depreciation expense is subtracted from the operating expenses because it's a non-cash expense. The net amount is divided by 365 days in order to convert the annual cash operating expense amount into a daily amount. Days cash on hand is the number of days the daily cash operating expense can be supported by cash and near cash balances. So let's see this measure for eBay. So as it says here, the measure can be used to estimate how long the business could survive a catastrophic event such as a software virus for an internet company or a national health emergency for an airline. I think COVID was a good example for that. So you see here for year one, the cash for eBay was about 2 billion. The short-term investments were 3.7 billion. The operating expenses 5.4 billion, and the depreciation expense 676 million. So the same numbers for year 2 and year 3, but let's see how we do the math here. So the cash and short-term investments are added together. So you can see here for year 1, we got this total for year 2 and year 3. And then the daily cash operations, we get the amount of operating expenses minus the depreciation expense divided by 365 days, and we got these numbers. And then we divide the cash and short investments divided by the daily cash operating expense to get this day's cash on hand. And you can see for year 1, it was like eBay was able to run for 447 days, but in year 3 it went down to 194.8, which is way less compared to what it was in year 1. So by that, I conclude chapter 7. I wish that this was helpful. Let me know if you have any questions, and enjoy the rest of your week.